Hello and welcome to the Quantitative Methods in Retail Supply Chain webinar. This presentation is the first of a series of webinars that will be presented by the 4R Systems Analytics team. My name is Kevin Stadler and I'm the President and CEO of 4R Systems, and I'll be monitoring the session. This webinar will be recorded and will be available post-event on our website. As a little note before we get started, all of the phone lines are currently muted and will remain muted throughout the presentation. We'll be taking questions via the chat feature on the right-hand side of your screen throughout the webinar, and the questions will be answered at the end of the session. We will answer as many questions as possible that time allows. And now I'd like to introduce your presenter, Stefano Alberti, our Senior Vice President of Analytics. Stefano?
Thank you, Kevin. Hi, my name is Stefano Alberti. I'm the Senior Vice President of Analytics here at 4R Systems, and welcome everyone to the seminar. Today, we're going to talk about quantitative methods in retail supply chain. What I'm going to do, I'm going to walk you through a spectrum of topics from the ground up. We start with some very basics and we'll see what makes retail tick, all the way through more advanced themes, and we'll touch on two specific hurdles to success in retail, and we'll do a deep dive on one of those that is particularly close to 4R Systems. So let me start with basic what I call Retail 101, or the retail cash cycle, and let me explain this with an example, which will be very familiar to most of the attendees. Let's say that I decide to set up a retail business, and to do so, I borrow $1 on January 1st from a bank at an interest rate of 5%. I'm going to use that $1 to purchase merchandise and put it up for sale at a 50% margin. Let's say that it takes a number of weeks, 5 weeks, to sell all their inventory. So after 5 weeks, I will have $2 in my pocket, because it's $1 of inventory sold at 50% margin, $2 in my pocket, and that's my revenue. I'm gonna put one of those $2 in my pocket as profit, and the other dollar I'm going to reinvest it into the business. I will purchase another $1 worth of inventory and repeat the cycle for and so on. Over the course of 1 year, I will repeat the cycle 10 times, and that will get me to the end of the year where I can pay back the loan to the bank, the $1 plus the 5% interest. And repeating this cycle, I will have netted $10 minus the principal that I paid back and the interest. It's $8.95 of pure profit, with $1 of inventory that allows me to keep the business going. So from the surface, it looks like it's an incredibly profitable business and sustains itself. It generates very high profit. Of course, this is a very simplified rendition of how retail really works, but it does explain why it's one of the oldest professions in the world, as far as we know. At this point, let's introduce a couple of concepts that we take for granted and probably everyone is familiar with. The first one, of course, is margin, which is basically defined as the component of the sale price that represents pure profit. So another example I have here, if I'm selling something at 25% margin, that means that for every dollar of sale, 75% or 75 cents is the cost of goods sold, and 25 cents is the margin, the profit. Another one, the second concept we're going to be using as a metric of health, or describing the dynamics of retail, is turns. Turns has to do with inventory, of course, and it measures how many times over the course of a year a retailer will cycle through inventory. It's defined as the ratio of annual cost of goods sold to average inventory at cost. And again, it gives an idea of how quickly inventory is moved through sales. For publicly traded companies, these two quantities are easily derivable from public available data. In particular, the margin can be derived from the income statement or profit and loss, by looking at total revenue and cost of revenue, with the gross profit representing the percentage of the revenue that is the net of revenue minus cost of revenue or cost of goods sold. And turns also uses cost of goods sold on one hand, and the inventory comes from the balance sheet, because inventory, unlike revenue and cost of goods sold, is not a flow measure, it's a snapshot measure or a level. In theory, we would need the average weekly inventory. If we look at quarterly balance sheets, we can approximate that taking the average of the 4 quarterly numbers, which gets us pretty close. Once we have those two components, we can calculate the ratio of cost of goods sold to average weekly inventory, and gives us the turns. Now, why do we go through this exercise? Because I'd like to show you how different retailers fall with respect to one another in terms of turns and margin. So let's say that we are identifying a number of retailers on a turns versus margin chart. And I have put initially 3 up here. Costco in the upper left, Target, and A&F is Abercrombie and Fitch. We have extracted from publicly available data the components that allow us to calculate both turns and margins. So a couple of comments here. First of all, why the different spread, the different levels? Well, Costco, of course, everybody knows their business model is predicated on very thin margins, which, of course, drive incredible volume of traffic and sales. Target also is seen as a value retailer, of course, with healthier margins compared to Costco. And Abercrombie and Fitch on the other side of the spectrum, very high margins. But besides the spread in margins, which is really a decision of the retailer of what they sell and how they position themselves in the market, the other obvious distinction here is in turns. Turns is a little less maybe intuitive to understand. Of course, Costco shows incredibly high turns, 12, which basically means that they cycle through their inventory 12 times a year, which approximately the converse of that means that they have about 4.5 weeks of supply. What does turns mean? How does it relate to how and what the retailer sells? Basically, it really relates directly to the concept of velocity. How many units of product is the retailer selling for an average SKU in an average store in an average, say, week? If anybody who's been at Costco knows that merchandise almost literally flies off the shelf, whereas if you walk into an Abercrombie and Fitch store, it's a lot less traffic, a lot less volume of sales, and Target pretty evenly splits that in the middle. An exercise for the audience here is I'm going to put 3 more retailers on this chart. So before I do so, I'll ask you to mentally go through the exercise of trying to locate where each of these will position in this chart. So the first one is going to be Walmart. So Walmart, as you probably guessed correctly, it falls right there in between Costco and Target. Thinner margins than Target, but healthier margins than Costco, with a velocity that sits more or less in between, if not quite exactly in between. GPS is the Gap, which has healthier margins than Target, but that comes at the expense of velocity, so lower turns. And then the last one is Ann Taylor, which is going to occupy the obvious empty space there between the Gap and Abercrombie and Fitch. One more note here worth mentioning is that the 3 retailers in the upper left are hard good, let's call them hard good retailers, and the 3 retailers in the lower right are fashion clothing retailers, which typically come with higher margins and lower velocity, and so lower turns. an obvious reason for lower turns and lower velocity for fashion retailers is that their assortment is spread over size. So we may have 15 or even 20 different sizes for the same style of jeans. Of course, what that does, it creates necessity for a good deal of inventory to service jeans demand in that style, causing lower velocity and higher weeks of supply or lower turns. Whereas the same relationship that we observe at the macro level, looking at individual retailers, also exists if we go one level deeper within a retailer and look at different product groups. Here we're looking at a retailer. We have separated the products and aggregated them by margin, and then for each margin range or bucket, we calculated the average turns. Of course, there is a little bit of noise, but you can see that the same inverse relationship holds between higher margin, lower turns products and lower margin, higher turn products. And an example of that is a kitchen accessories retailer that has 15 plus different garlic presses that differ from one another more or less slightly in form, but not in function. Of course, assortment proliferation, I mentioned this because it's one of the drivers of lower turns. And in a vicious cycle, as you have lower turns, you have to make it worthwhile to carry all that inventory, and so that requires also higher margins. That's another reason why lower turns and higher margins go hand in hand. Another reason that explains why lower margin and higher turns also go hand in hand is when you have more basic products. The classic example is toilet paper. Every retailer will sell a lot of toilet paper, very high velocity item, but they're all very low, generally speaking, all very low margin. There's a lot of competition. There is very little uniqueness about basics like toilet paper, and it's a very competitive environment, even though demand is very high, and it explains higher turns. One more note about higher turns. When demand is higher, it's also more predictable because, relatively speaking, it's subject to less random fluctuation for the law of large numbers. So having more predictable demand allows the retailer to service that demand carrying relatively less inventory meaning fewer weeks of supply, which in turn means higher turns. So there is more than just an assortment or margin explanation. There is also a demand and basic stocking policy explanation to higher demand, higher velocity, and higher turns equation. So it looks like retail is such an appealing business. Everybody can make a bundle. In reality, it's not so. There are many reasons why going from theory to practice is difficult to really make a lot of money in retail. Today, we're going to focus on two such aspects or obstacles. The first one is the fixed cost or overhead associated with running a business, in particular retail. And the second reason is the uncertainty of consumer demand. So let's talk about the first one. Again, I like to use an example, and I'm going to take Costco as the first of the two examples. I call this feeding the beast because what I'm showing here is the income statement portrayed as a waterfall. As we move from the left to the right, we go from a revenue or top line, and then we see how it splits in all its components. Costco, most of the largest component of revenue, because they have such thin margins, is the cost of goods sold. So that accounts for almost 87% of revenue. The remainder goes a little bit, 10%, in running the business, basically the overhead which means real estate, insurance, payroll, utilities, and so forth, legal department, HR, everything. The largest, whereas the first column, the cost of goods sold, really depends on what the retailer sells and how they want to position themselves in the market. So high margin for Abercrombie & Fitch, low margin for Walmart or Costco in this case. The SG&A, selling, general, and administrative expenses and other expenses, really depends on the efficiency of the retailer. So basically, we would like this to be small so that it takes out a smaller chunk of the top line and leaves more for the bottom line. To some extent, we can interpret this SG&A as a measure of the efficiency of the retail machine for everything that does not involve retail, but basically just the overhead associated with running the business. One last comment about this waterfall is that the income is a very tiny 2%. 2% of a large number is still a large number. But what jumps to the attention here is that the 2% is the difference between two or three very large numbers. And as one or more of those large numbers fluctuates a little up or a little down, the 2% can wildly swing upward or downward, even possibly becoming negative. The other example at the other end of the spectrum is Abercrombie & Fitch. And we have, again, because of market positioning, they sell much higher margin merchandise. So the cost of goods sold takes a much smaller bite out of the top line. However, they are a much less efficient retail machine. The fixed cost, the overhead, takes a much bigger bite out of the top line. So I like these two examples just exposed to one another because they exemplify the two different dynamics going on. The market positioning associated with the cost of revenue and the margin and the underlying margin, and on the other hand, the efficiency of the retail machine, of the machinery that supports the retail business. In this case, their income after tax, this actually was from a couple of years ago, is quite healthy, 12% of top line, which is quite a very healthy number. One more aspect one more theme to touch on is the near obsession that retailers have with growth, and even more so retailers that are publicly traded companies. So the obsession really is coming from Wall Street. And the best way to show this with an example, let's look at a retailer with annual revenue of $500 million, margin of 40%, which means the cost of goods sold is $300 million for a gross profit of $200. Let's say the SG&A is $180, and EBITDA, earnings before interest, tax, depreciation, amortization, is $20 million. So these are common numbers for a retailer. Let's now look at two alternative scenarios for the year 2 and following. One is a flat sales, so revenue will stay at $500 million year over year. The second scenario is with a small but steady growth of 1% year over year for a foreseeable future, let's say 20 years. So the two scenarios are year 2, flat, looks exactly like year 1. Year 2, we have a 1% growth, so from 500, 505. Of course, if we sell more, it also costs more. The cost of goods sold is a higher number at the rate of 1%. Gross profit also grows by 1%. Here, I'm making the simplifying assumption that SG&A doesn't change, not even by 1%. And this is because if a retailer is able to squeeze 1% more out of top line, it's because maybe they chose a slightly more attractive assortment this year, or maybe they were able to execute more efficient markdowns, or some minor change like that, which does not have any implication on the underlying structure of the efficiency of the machine in terms of anything that does not relate to retail. So payroll, real estate, all that, we assume it's the same. Well, that $2 million, therefore, incremental $2 million fall to the bottom line, and the EBITDA goes from 20 to 22%, which is already a 10% jump. So a 1% jump in revenue translates to a 10% jump in EBITDA. If we use a standard net present value model with a 5% annual discount rate, the two valuations are, consider the next 20 years EBITDA annualized. For the flat line scenario, no growth, $249 million. For the 1% year-over-year sales growth scenario, an astonishing $676 million, which is almost 3 times as much in terms of valuation. If instead of 1%, the growth is 2%, then the NPV value is over $2 billion. You can see how these numbers are quite surprising, because a small annual growth over a long term translates into an incredible increase in value, which of course translates into higher stock price due to expectation of future growth, and that partly at least explains why retailers are so keen on showing year-over-year growth, pursuing year-over-year growth. The second, if you take a step back, we said there are 2 hurdles to achieving great success with retail. One was the overhead, the expenses, and all that. The other one is the dealing with uncertainty. The uncertainty in this case comes from the uncertainty of consumer demand, basically not knowing how many customers are going to want to buy what product and where and when. And the uncertainty puts capital at risk, because there are decisions such as what to buy, how much to buy, and once we have inventory, where and when do we put that inventory? Do we allocate an inventory? Those decisions translate, in particular, the what to buy means assortment. How much to buy is the depth of the buy, which exposes the retailer to errors in both directions. The overbuy, which will cause excessive inventory carrying cost and unnecessary markdowns, well, necessary markdowns, but painful markdowns. On the other hand, underbuy, which leads to missed sales, which is a very costly mistake as well. And eventually, where and when. This is more of a tactical aspect, but it's very important, because all the retail chemistry that happens is at the point of sale, when inventory and customer meet each other, and there is a chemical reaction that generates cash for the retailers. And if one of the 2 components is not there, or is there at the wrong time or the wrong place, the chemistry doesn't execute in its full potential. So flowing goods throughout the supply chain, whether it's from vendor to warehouse, or even more tactically from warehouse to store, is another decisions that is highly affected by consumer demand uncertainty. So let's talk about uncertainty a little bit more. Like we said, the root cause of most retail supply chain pains is demand uncertainty. There is this idea of a perfect forecast. Well, a perfect forecast does not exist, not because we are not able, we don't have techniques, there is not enough computing power. The reason is that we're trying to forecast what is inherently a stochastic process, a random process. So much like I cannot forecast what the next face up on a dice that I roll will come up, I cannot forecast exactly demand in a particular store, particular SKU, particular point in time. However, that said, if we accept that there is some uncertainty to deal with, then every inventory decision really represents a form of hedging against the uncertainty at any specific point in the supply chain. Traditionally, retailers have always recognized this situation, and there are 3 standard levers that they've been using. The first one is to try to forecast more accurately, whether that means more science thrown at it, better algorithms, better processes for acquiring data, more recent data, more accurate data. But that's one lever. The other lever is, well, just put more inventory. That's not a very smart way, but it's an effective way to capture more demand. And the third way is to make the supply chain more agile so that we can respond to changes in demand more quickly. All three are effective, not necessarily cost effective, but they are effective. But they do cost money. For example, forecasting more accurately, whether we're investing more in the science or more labor, of course that costs money. Deploying more inventory, obviously that costs money because we're injecting more inventory in the system, and that's the primary cost that we're discussing here. Making the supply chain more agile is a very noble endeavor, but it also costs money. For example, shortening lead times may mean transitioning from train to freight, or from LTL to small truck delivery, and so forth, which costs money. Lowering case size, yes, we're making the shipment from the DC to the store more agile, because maybe we're not shipping in increments of 24, but only increments of 6. But that comes at the cost of reduced or increased shipping costs, more handling costs. Increased review frequency. Maybe instead of once every 2 weeks, we can review once a week or twice a week. Again, that's very effective in making the supply chain more agile, but also comes at a cost. In this case, labor cost and process cost as well. So given that our goal is to meet demand profitably, right? There is this thing called right amount of inventory, which is a little bit of an elusive target. And all retailers are familiar with this, and they know very well the trade-off and the two extremes. If we have too little inventory, low sales. If we have too much inventory, high carrying costs and risk of obsolescence. Those are the two costs that we have to take into account in the elusive search of the right amount of inventory. So these are the three, I mentioned the three traditional levers that retailers have to try to achieve that balance: forecast more accurately, deploy more inventory, or make supply chain more agile. There is actually a fourth way. We like to call it the 4R way, of course, which is to use possibly the same forecast, the same supply chain, the same everything, but to make better decisions. So it's almost simplifying. It's like using the same ingredients, but using a better recipe to affect a better outcome, to achieve a better outcome. And the trick there is to align inventory decisions to global profitability goals. Well, how do we do that? The first step is to recognize the random nature of demand. So no matter how good our forecast is, it's not going to remove completely what we call forecast error, but it's really a misnomer. It's not forecast error, it's the underlying uncertainty of demand. And then once we have that infrastructure built around the uncertainty of demand, we apply science to navigate the trade-off between balancing investment in inventory, which is the risk, and servicing the customer with a sale, which is the reward. A typical way of displaying that that balance is looking at the relative cost of a lost sale, which for replenishment items, for example, is the cost, the margin of the item, versus the cost of excess inventory, which could be driven by inventory carrying cost or possibly even obsolescence. When the balance is skewed toward too much inventory, is the Turkish bazaar situation. Conversely, when the retailer engages in an efficiency drive, because maybe the CFO is screaming louder that time of the year, then inventory lightens up, but then the service level suffers. And it's not quite the Soviet shopping experience, but even a 0.5% or 1% lower service level, everything else being the same, can be a very costly mistake. And sometimes there is a back and forth between efficiency drives and service drives, because the retailer is pursuing local goals. So applying science really means applying science in a way that a global measure of optimality is achieved. And the two costs are balanced, not literally in the way that the two costs are equal, but in a way that the sum of all the costs is minimized, so that putting more inventory would lead to high overall costs, and putting less inventory would also lead to high overall costs. So how do we do that? What's the secret recipe that I mentioned earlier? Well, it is optimization that we use as an approach to deal with uncertain outcomes. The first step is to recognize and model demand uncertainty. So, of course, everybody recognizes it, but we also have to model it and incorporate that model explicitly into the science that whose outcome or output is the specific inventory recommendation. And the second, the process, once we have that input, the process to which we inject that input is a process that links decisions to their economic outcomes. Well, what decisions are we talking about? We are talking about where to put, how much inventory to be deployed, where and when in the supply chain. And the economic outcomes depends on all the costs that we mentioned before, whether it's the cost of a lost sale, the cost of carrying too much inventory, obsolescence, and so forth. Using these two, one and two, in the right way, gives rise to what we call stochastic, what is known as stochastic optimization, whose goal is to manage decisions to make the most profit. And this is not profit for one part of the retailer. This is global profit. So we are not, for example, increasing the size of a case pack or a pallet because it's cheaper to ship, even though it may hurt us somewhere else. This is global profit that takes into account all the cost components, all the profit components. That's exactly what 4R does. The optimization is focused on the profit, and we consider all the costs so that we avoid moving problems from one part of the company to another, which is another way of saying optimizing locally at the global detriment. This is global optimization. Another rule of thumb is if a retailer is following target weeks of supply or target service level models, they're probably doing okay, but they're not doing as much as they can for their supply chain and their management of their supply chain. So let me wrap up here with a little bit more insight into what is the science that we use of 4R for achieving the global optimality. There are really three areas of ingredients or inputs that we have to consider when we try to make a profit optimal inventory decisions. One is the economics, of course, because this is all about layering the economics to achieve the optimal outcome. So whether it's the margin of the product per se, or the carrying cost, obsolescence, and so forth. Of course, demand plays a huge role, but like I said, it's not just about mean demand, it's also about the variability of demand, recognizing that the demand is a stochastic process with its own variability, which can vary from product to product. And then, of course, the structure of the supply chain through its parameters, be their lead time from DC to store, or vendor lead time, case size, review period, and so forth. We take these three areas of inputs and we incorporate it in this stochastic optimization, which yields the optimal trade-off between cost of inventory and cost of lost sales margin. And as I'm running out of time, I'd like to wrap it up here and open the session for any questions.
Well, it looks like we got a couple questions here. One is, how do you reduce out of stocks and at the same time increase service levels?
Excellent question. So, a claim we often make is that we manage to lower overall inventory and at the same time achieve higher sales by recapturing some of the lost sales that are currently due to stock outs. Well, how do we achieve those two seemingly opposite results? Lowering inventory globally doesn't mean that every store, every SKU, every week we are taking out inventory. We may lower inventory in some parts of the supply chain where we might increase inventory in some other parts of the supply chain. And we do so in such a way that when we lower inventory, what we lose in terms of lower service level is more than offset by what we gain in terms of service level, increased sales, in places where we increase inventory. So that the net gain between the delta inventory and the delta lost sales or lost margin is positive. And possibly overall, this balance of reducing inventory in some points in the supply chain and increasing inventory in some other points of the supply chain leads to an overall reduction of inventory and also an overall increase in lost sales recapture.
Okay, great. One more question that we have here. You mentioned that target service levels aren't used at 4R. Can target service levels be used if they are well thought out?
Well, there is nothing wrong with target service level, but they always end up leaving some money on the table. Now, one could say, well, but I have the optimal service level, which may very well be true for a particular product or point in time. But as any of the factors change, whether it's, again, the economics of the quantities involved or more likely demand, either in volume or variability, or even more likely supply chain parameters, case size, review period, then any change in any of those input parameters would lead to a different optimal service level. So unless we have a way to tie all those parameters to the optimal outcome, meaning the profit optimizing inventory level, then a service level approach would fall short because it would not be reactive optimally to changes in the environment that I mentioned before. Okay, so this takes us to the end of our session. I'd like to thank all the participants and thank you for the question you submitted. If you have any additional questions, feel free to send them along to the channel. And I look forward to the next session of the analytics team. Thank you very much.